What's up everybody? Tom here with another video. Well, if you've been looking at the markets, whether it's the crypto market, stock market, or commodities over the last couple of weeks, you've of course been seeing volatility. And with volatility comes out people's opinions. Whether it's buying the dip strategies turn out to be terrible, or of course, whether this is going to be a bigger potential threat with, of course, the US debt ceiling and Evergrande situation. There are conflicting opinions, and that means we need to be able to cut through it. In today's video, we're going to be able to cut through all of this information and really bring down the key levels that you should be looking at in the markets right now. Stay tuned, guys, to find out more. All right, well, here begins our market recap for the markets closed 21st of September 2021. And when we take a look at a heat map here, it looks like nothing much happened. And that's because it was futures market action. We opened up and then we came back down, and that was pretty much the session. Let's take a look here. You can see the open, the retail hour of power created a bit of a sell-off. And then we had some rally, trapping in more retail traders, and ended up basically flat at the end of the day with some selling into the close. Now, it's interesting because when you think about it, what could Wall Street have done? Over the Monday session, what did they do at the end? They pushed it down, bought it up heavy. Let's call it a dead cat bounce style scenario. Then they opened the market even higher at a key critical resistance that we saw in our live chat, and then they push it back down a little bit, taking some profit. It's sneaky, but it's the close that's the key. And we saw the close basically neutralize over that period. When we take a look at all the sectors, wow, it's up, down, and all around. I don't think there's a clear sector here that you're thinking, oh, it's amazing. Of course, biotech is out in front, but I wanted to bring everything back here just for a second and to discuss the year to date for all the sector rotations. Now, I would actually guess that most people wouldn't be able to guess which sector has done the best. Real estate. Can you believe it? XLRE. The REITs have gone crazy. 29.4%. It was a massive laggard last year. When everything else was recovering, XLRE was not. And it just shows you that when you understand sector rotation, you can really do a lot better. I'm not a fan of XLRE and REITs in terms of investments. However, if you spot that and you see the difference, you can really see what happens here. We do expect as well XLP and XLU, utilities and consumer staples, to stabilize and to flatten off, because these are mostly usually dividend plays and also defensive plays. They come back into their own later on in what we are looking at is probably a new bull cycle here. Obviously, we had a bull cycle, but what you'll notice in all bull cycles, XLP and XLU come really, really strong near the end. XLV being healthcare, that's generally one of those kind of mid-cycle stocks or mid-cycle sectors, and we have seen that start to get a little bit better. You'll notice throughout the year it started flat. We got very bullish on it around April, and it certainly performed, I believe, pretty well since that April period. So there's a lot of convoluted kind of stuff going on here. We've got sideways action on quite a few sectors, and that can create, some opportunities. XLB is another one to look at. The material sector's been beaten down recently. Has that started to stabilize? It really hasn't done much. You'll notice XLB over here on the left-hand side is basically the same place as it was from February. So something to watch out there and have a look at these sectors, and people are starting to do that. So when we're talking about the market as a whole, before we get into a technical analysis and options studies, we want to think about the put-call ratios as well and where we're at in comparison to maybe other times that the market's picked up. So if we have a huge amount of puts in the market, so that's of course a high number here, generally the market cannot go down. Why? Because really, if there's tons of puts, the market doesn't want to pay out those options. Remember, 70% of options expire worthless. If everyone is doing something in options, often it will not actually go down. And I want to take us back to a point in August, because a lot of people obviously thought the market was crashing or was falling in August. So we saw that start of a bit of a drop here, 0.57 on the 13th. Then we have the 16th, 0.54, 0.58, 0.52, 0.61, and then it started going long. So right when it got that really high number, it started going long. What's interesting about this current breakdown, or the current movement that's been a little bit slower in some ways, is that we're still sitting in relatively low put-call ratio numbers. So we haven't had that consistent 0.5, 0.5, 0.5 into a 0.6 number. In fact, we haven't even had a 0.6 number. I might be looking at 0.6 numbers to correlate with supports. So I think that's something we're going to start doing here on the channel, and there's some reasons why, but I think that might be worthwhile checking out. Let's take a look at the VIX to get into the technical analysis. This is often known as the fear index, if you're not aware. Basically, it tracks, of course, the volatility in the market based on options over a period. And realistically, it is sitting here, 24.35. Is this pretty high? It certainly is. It's showing that the bears are kind of in control of the market at the moment. And would I trade it? No, I don't think anymore. I always like it under that 16 for the trade long. But at this point, yes, there's going to be some increased volatility. And of course, if the market starts to short again and go down and hits new lows, expect the VIX to really start pumping back up there, maybe even over the 30s if we get new lows coming up. Let's take a look at SPY though, and we'll start with the weekly here. So we'll see that the weekly's trapped between two zones. We've got the 430, which is an incredibly important zone we'll be looking at throughout the sessions this week. And then we have, of course, this previous level of support and resistance that acted as a key zone over the last 24 hours. And if we actually go down to a 2-hour chart, you're going to see a few reasons why this occurred. In fact, let's go down to a 1-hour chart on the SPY. So there were some things that happened in the live trading session that we talked about over the last open. And that was that we believed that it would try to fill the gap. And there were many, many reasons why that occurred. Number one, the market was actually opening at the resistance. So previous support, previous support, previous support, resistance. We had a gap between this previous close and where we opened. And you'll notice that the market closed that gap. Now, not all gaps get closed. Remember, this gap will eventually get closed because the market will eventually go back up. But it's not closing just yet. Is this a good gap to be looking at and aware of? Absolutely. And we've got a key zone here now on the S&P 500 to be looking at. So this is where we were at. This is where the market ended up pulling back down to. If you took a trade short there, I totally don't blame you. It was a good day trade. Congrats to you. And there were a few shorting opportunities off that zone. Now the 20 moving average on the 1 hour has caught up with the market as well. And we've got a bit of base formation here. So we've got kind of like a trough. We've got a peak. We could be getting a higher trough here. And of course, we close above this zone. What's happening then? We've got what we call the lightning bolt, and we may have just put the base in. That could have been the lowest point we're actually going to reach in this market pullback. Once that occurs, where do we look to fill? We look to fill the gap between these two zones. It makes sense. It's logical. It's something that we like to do in trading, and I think that's very good. Now, at the time of this recording, we also have the other scenario where after we gap fill, we continue to weaken down to this point. Will there be buyers at 430? I hear you ask. I think there will be buyers again at 430, and I think a lot of it comes down to options. So let's take a look at the option strikes for the upcoming expiry, the major one, the Friday, 24th of September. And we've got to remember as well, we've got the FOMC statement coming out, as well as Jerome Powell speaking later on this week, as well as the ever-evolving US debt ceiling and Evergrande situation. So all of these things can be potential catalysts, bullish or bearish, depending on the markets. We've got so many calls expiring around that 440, 450. So really 440, 450 on the SPY, both of these levels are not ideal for Wall Street to allow the market above it, especially 450. They don't want to pay these guys out. Come on now. Who wants to pay retail out? They don't. They've also got a huge amount of puts at 430. So when we're talking about where we expect potential, bottoming for the market this week, we've got to think this 430 is a key level. And we discussed this in our weekend video. We hit it straight away on the Monday session. And guess what happened? Strong buying happened off that zone. Why? Because we're stuck in a range between options expiries. If we push it out to the middle of October, the major kind of expiry point for October, you'll notice things become a little bit different. We've still got a 430, which is the major puts here, but they're more spread. And we also still have a huge amount of 450 calls. So this is what makes me think that we could be in a market which isn't just going to V-shape straight away. It could go like this. Movement up, movement down, movement up, hit the gap, movement down, sideways action for a little bit, find the base, maybe even go further. That's certainly a scenario. We've also got the scenario where it just keeps dropping, comes down to the base, bounces, and then moves underneath. So that's that 430. And as soon as we get the options expiry coming in through Friday, let's say we expire just underneath there, they pay out a little portion on that, and then the next week we get that further down leg. What do you guys think in the comments? Is this the base? We're moving up now? Put bull in the comments down below. If you think you're still bearish and you're going to get that new low, put bear. It's great to see your sentiment as well. But again, I wouldn't want to pay these 450 calls out. And that's the major last expiry for all the bulls that went in on the market over the last month. Remember, that August period really convinced everyone, we've got to buy, we've got to buy, we've got to buy. If we take a look at the SPY flow heat map, this is so ridiculous. This is the difference between the calls and the puts and all of the ones that were traded over the last session. And when you take a look at this chart, you're like, wow, that's telling me nothing. Yes, you are correct. This is absolutely garble. It's massive amounts of puts, massive amount of calls all over the place. Net negatives, of course, for the options expirations coming into October and September, and then October and November, sorry, and then December is relatively bullish. I'm not tending to go negative for November. I tend to think that November is one of those stronger months and we'll actually be more bullish there. But that's only because everyone's going so bearish on November from the put side. We'll keep watching it. It's an ever-evolving situation. Obviously, it's a 24-hour kind of changes here we need to be aware of as a trader or an investor in the markets. So the SPY stuck on that 430 put wall could be something we're looking at this week. Let's take a quick look at gold. I think we might as well have a quick discussion here. We ended up seeing a base formation for gold. If people got in maybe off this bullish hammer, well done to you. There's been an okay trade here up to this resistance. And we say it's resistance because, of course, it's previous support. So for gold to get through here easily is going to be a bit tough. This is exactly the zone where you expect some sellers to come in. And if you do rally through there, I'm not really interested in gold until it hits past the 1830. That's my main key alert. You'll notice this box structure up here. I love the 1830 breakout. We get that, wow, great participation phases, great ability to rally off that point. And that's something I'm looking for strongly, especially into December. So December's a great seasonal there for gold. And if you're a gold bug, you can go check that out by checking out the Decembers of the last couple of years and seeing how they've performed. Before we go into other indices and discuss more the S&P 500, Nasdaq, etc., let's take a quick look at Tesla. We've still got our long-term trend line here. We do like the trend line. That's been an exceptional buying zone for a little while here on Tesla. And if we actually take a look, we've got the long leg doji here over the last Monday session, and it didn't break above or below. So that means that we don't have a decision made yet. We have good resistance through that 726. We have good support, of course, coming in now. Long leg doji, we close above. We start to think about retesting those 760s. And it makes sense to me to do that. Now, if we get underneath this zone, back to the trend line around 700, and the 700 should be the put wall. Because take a look at these expirations here for the 24th of September. Whoa, so many puts, guys. I don't know who's doing this. Could it be Michael Burry? I don't know. There's so many puts sitting at 700. This is nuts. But again, that's okay. We know the information's there. There's a put wall. If it gets to 700, if it gets to that trend line, we do not expect it to get underneath that zone in most situations. That's what we're using this for, to find out most situations. From the amount of calls coming in, of course, we always expect retail to get in pretty heavily on Tesla. They're buying 740 calls this week, net positive 9.19 million. That might keep it underneath for a little while, but again, it's really this 700 put wall. I doubt that gets paid out. Tesla algo flow, pretty consistent with price. Nothing much to see there. And if you're interested in any of those charts and more coverage that we do, of course, you can check out fxevolution.com in the description below. Join the 7-day free trial, get into the private community, or of course, check out our courses there if you're interested, guys. Let's take a look at Apple. We have here a great level of support that was reached with that 141 level. Long leg doji, very similar, as you could see, to Tesla. The market's doing the same thing across the board. We didn't see a closure above. We certainly didn't see a closure below. So we're stuck in this range for now, and we're looking for decision made long or decision made short back down to our glorious trend line. And I would love to see this trend line. I'm sure a lot of people in the private community, public community, pretty much incredibly excited about if Apple gets down to this trend line. They love that 135, that 130. They're excited for all those levels, and I don't blame them because that's a trend line that's held now since August, October 2020. It's a pretty serious beast there. Take a look at the algo flow again. Strong buying here from the street, strong buying from retail as well. and the price has maintained, because I think what you do during these times is that fund managers are basically like, oh, well, can I get some quality stocks at slightly cheaper prices for my clients? I might as well stack into Apple. I'll sell off this other trash that I have that I don't really want, that hasn't moved much, and I'll go grab some stuff that I'm very interested in. AMC here might stop covering this for a while. We don't really have the strong bullish intentions. We got to where we wanted to, and now we're basically at a zone where, you know, the 40 failed yesterday. It came back to the 38.82. We know this is a very critical little zone for it to come off, but we haven't seen that turnaround. And I do prefer AMC to the long side whenever possible, unless it cracks through really key supports. And we know there's like a key support around this 32, but we get underneath 38. I kind of feel like 32's incoming, and then we could be boring for a while we base form with the hodlers around there. So AMC, not really a trade here as far as I see it technically, unless you're wanting to look for the short side. And the long side, it's really at the last point before it goes really further down back to that 32. You close underneath this little like indecision candle, all of a sudden you go back to the 32, and you start talking about having to create the base we saw over here, which created all that nice movement over there. That's how we kind of look at AMC. If we take a look at the actual algo flow, it was generally positive with the stock, and the stock was kind of sideways. So yeah, it wasn't shocking. However, it's not exactly strong. It has to find base support here. Let's move over to some of the other indices. We'll check out IWM to start with, the Russell 2000. A lot of people like this one. I'm not a fan of trading it, but I do like, of course, the option strategies on it. I think they're a lot better. If we have a look here, we have the 220 as a resistance. If we close above the 220, then we can move back to the 225, the 230. Every $5 kind of matters. And at this stage, it's looking more towards that short side, that 210, 208. If you're not aware already, IWM has been in a monster channel. If we take a look at the weekly, you'll see it is literally stuck in the middle of nowhere land for quite some time. In fact, all year it's been stuck in this channel. Imagine if we broke out to the upside. That would be phenomenal for IWM, but it hasn't happened yet. We're stuck in the middle, and you can see it's literally the middle of the range, so nothing much. Let's take a look at US 100. So we discussed the point that the S&P 500 was right at resistance. Hey, what do you know? So was the Nasdaq. You can see here previous resistance acted as a level of resistance. Again, it makes perfect sense that it would sell off this level. We talked about the bears fighting it out here. This is exactly where they're going to want to do it. And if we take a look now at the NDX, which is, of course, got the gaps in it because it's the real market, not the futures market, you'll notice that it filled that gap. So it filled the gap down, shorted off. And if we get now a new high past this point, so these points are, let's call it, we probably want to get about 15,170. If we get above 15,170, what we've done is we've effectively created that. And where do we expect it to fill to? The gap zone. Very nice participation trade should it go bullish. If it keeps going bearish, that 14.8 is pretty heavy support buying for the week. And I expect it to take more buying bounces off there if it is going to happen. And realistically, underneath that zone, well, it opens up some very interesting levels. That's when you start looking at your SPY and you start saying, well, are we really in for the proper correction? I mean, if we go to the SPX here, which is always probably the best major support resistance kind of finder, and we start talking about the next key levels, we're talking about this 42.50 zone after that new low. I mean, you can see it clearly. Resistance, support, that's going to be an area that people are looking at in the markets. It's not really, it's still in the middle of nowhere land in terms of the moving averages. And the deepest I think we go, unless some catastrophe happens, is going to be around here, 4,050. That would be a phenomenal level. Previous strong buying, great psychological zone, and more importantly, the 50 exponential moving average weekly. One of the most common pullback moving averages for the deeper pullbacks of the year. Look, 50, 50, 50. We love the 50 back in history. This is what happened during 2012 to 2015. Look at these 50s. That was the best it got. 20s on the weekly, the common one, the mean reversion, or the 50s. Sometimes you get deeper, but in general, these are incredible levels. So we'll be watching these ones very closely. I want to let you guys know that we'll be covering on them channel, of course, to help you out. Other than that, I think that the market is clearly playing a little bit of funny business. The futures have been up, down, and all around. You can see there's a lot of trap for that buy the dip scenario, most likely attacking leverage, attacking options on the weeklies. I actually am more of a fan of taking options over the longer term, maybe a month, 2 months, 3 months. My average would be around there. The reason why is you can let your plans play out a little bit better. Sometimes you need to go quick and sharp, but you know what I mean. How many people have lost money trying to trade for a 2-day option? Options are great for securing your risk as well, because of course the debit side can be good. But yeah, just be careful there, guys. The options market is sneaky, and you've got to know how to navigate it a little bit better if you can. BTC, US dollar. This has been a bit of a terrible chart, really. It ended up closing low, back down at the previous resistances here, and what do you say about BTC? It's pretty doldrummy right now. It's nothing really fantastic. You've got Ethereum going to that 28, so that's that next level of support. It's gone straight down there to the resistance becomes support level. It's got to do some turning. Now I think Ethereum is probably the easier chart to look at than even BTC itself. You've got kind of like Ethereum rallying now to 3,000. It's going to find sellers here, you would think, sell off a bit. If it gets through 3,000, does the lightning bolt, then you can take it to the next level. It's not the easiest in terms of these key levels. I don't know why exactly it's getting so much weaker. You could say it's news related and everything like that, but I think it's also part of the seasonal. I still have plans for Bitcoin, Ethereum, and others into the October-November period. Remember, Thanksgiving leading up into that has been historically very strong during bullish years of the cryptocurrencies like it is right now. And we've even got things like Cardano sitting on that $2 big, strong support level buying zone. Cardano really trying to put that base in it too. Big psychological area. It has to hold. And if it doesn't, let the floodgates back open, because it's going to come right back down. Be nimble, be quick in the markets right now, guys, because there isn't really a great swing unless you're swinging down and going with that longer term kind of short trend that's happening here. If you're looking for the buys, you've got to be nimble and quick. There's no base formations coming into these markets just yet. Another thing that you'll be wanting to think about is, of course, we have a few big bits of news coming out. If we go to Forex Factory, quickly leave and go over here and we look at the week ahead, we do have the FOMC statement and economic projections coming out 2 p.m. New York time on Wednesday. Then we have the press conference 2:30 p.m. So that'll be something that moves the market. And of course, we've got Fed Chair Powell coming out on Friday as well. So the news is coming. The market's in the indecision point. It hopefully makes some decision to either fill that gap up in terms of the S&P 500 or come back down to the 430 on the SPY. And I think it's exciting. It's great times here to be nimble and be quick. Thanks very much for watching, guys. Remember to subscribe and, of course, smash that like button. It does help us out quite a lot. And are you a bull or a bear in the markets right now? Let us know in the comments down below. Bye for now.